Hello and a warm welcome to Econoday Unplugged on Tuesday, the 9th of March 2021. Mark Pender's stateside, and I'm Jeremy Hawkins in London. So it's the turn of the ECB this week to show whether it's prepared to put its money where its mouth is when it comes to trying to cap the recent uptrend in longer dated Eurozone borrowing costs. As we mentioned in last week's podcast, so far, the European Central Bank has been very active using verbal intervention to talk yields lower, but there's been little evidence of any increased bond purchases. Heavy redemptions may have been an issue here, but either way, Thursday's policy announcement and press conference will provide Lagarde and co with the opportunity to indicate to investors how far they're prepared to go. Now, the ECB's quantitative easing asset purchases are currently funded by its long-standing asset purchase program, the so-called APP, which since November 2019 has been running at a net 20 billion euros a month, and the so-called pandemic emergency purchase program, the PEP, which was announced in March last year. Now, the PEP has no predetermined monthly buying rate, but it does have a ceiling of 1.85 trillion euros. Now, I guess if this ECB actually wants to send a clear signal to the financial market that it's had enough of rising bond yields and actually wants to see them at least capped, if not decline, the easiest way for it to intervene in the markets would be via the PEP. Now, this is, say, much more flexible than the likes of the APP, simply because it doesn't have this fixed monthly target. And as things currently stand, there's still the best part of what I guess about $1 trillion or so euros available under the current PEP ceiling before it's reached. So there's plenty of ammunition and scope to step up PEP purchases without doing any damage or undermining the kind of progress they made so far on the overall APP, the asset purchase program. At the moment, I mean, the PEP's been running at net purchases around about 60 billion euros a month or so, and that's been the case since last December. Now, I guess that in terms of communication, the ECB could simply opt to make some statement to the effect that it will be increasing its bond purchases via the PEP in the official policy statement. Alternatively, they could leave it to Lagarde's press conference. Either way, I suppose it doesn't matter too much, but I think if we don't see some indication or at least something which leads financial markets to believe that demand for bonds coming out of the European Central Bank is on the up, and chances are that in itself is going to be taken as a view that, well, they're not really serious about capping these yields, and we could well see some additional spikes coming through thereafter. What we can say is, I think, with a fair degree of certainty, is that nothing is going to happen in terms of European interest rates. At the moment, we have the refi rate down at 0. Indeed, it's been there for a long time now. And similarly, if you like, the more important at the moment, given the way there's so much liquidity sloshing around, the deposit rate stands at minus 0.5%. Now, it's extremely hard, I think, to believe that there'll be any change to any of those. Even the more dovish council members appear to be of the view that there's no real net benefits to taking what are already negative interest rates further into negative territory. And indeed, I suppose it could be the case if they were to do that, markets are actually genuinely concerned about a potential pickup in underlying inflation, then loosening policy by driving down the shorter end of the yield curve at this stage could simply exacerbate those inflation worries and ultimately then just put additional pressure on the longer end of the curve itself. I think, reading between all the lines, to the extent it seems that we won't see any significant changes to the ECB's economic forecasts on Thursday. We'll get the quarterly update taking place then as well. And from what most of the governing council and ECB members have been saying, they're apparently taking a view that so far economic developments since their December meeting have been broadly in line with what they expected then in a central case scenario. So if we do see anything, it really does suggest it's going to come down purely and simply due to the way longer term borrowing costs are moving. Now, the thing about this is that, I think the big policy takeaway is that we still have a negative Eurozone yield curve all the way out to 17 years. So it kind of suggests, I think, that it's the ECB itself is still concerned about prospects for the Eurozone economy over the second half of this year. There's been a lot of, I suppose, bullish optimism about economic prospects for the global economy in general once we get through summertime due to the vaccine rollout. But of course, in the Eurozone, or at least in the European Union, that rollout has been disappointingly slow. The current rate amongst the four larger countries are Germany, France, Italy, and Spain. The vaccine rollout rate there is running at about a quarter of what we've got in the UK at the moment. Not much more than that compared to what we're seeing in the US as well. So it is still well behind the pack. And inevitably, with an increasing number, it seems, of these variants, which increase transmissibility, and indeed, we're not completely sure about just how the vaccines will cope with those in the first place. It raises the risk that we could see an underperformance by the Eurozone economy during the second half of this year and perhaps going into next year, simply because the vaccine hasn't been rolled out quick enough. And that is something which it seems the ECB itself has been intimating it really wants to see the delivery process being bolstered and getting a move on with this. Now,
Jeremy, I have a question on that. Is it the actual cause and effect here is tied to the restrictions being lifted? What is the status of the restrictions? Is it possible that there can be a slow vaccine rollout, but still openings will still be taking place in Europe?
Yeah, I think that's a perfectly fair comment. But I suppose, but the danger is, I think, the openings can only really take place on a sustainable basis, I think, once the vaccination process has been accelerated. What we're seeing at the moment is that for the Eurozone, in line, with a lot of the rest of the world, I guess, we saw another peak coming through in terms of COVID new infections, new cases in December time. Then they started coming down in January. Then they started going back up again, and it forced a lot of Eurozone countries to introduce new lockdowns or certainly tighter restrictions. Now, as we stand and we sort of speak at the moment, the latest indications are that what had been relatively significant improvements in terms of falls in new COVID cases out of the likes of Italy and France, well, they appear to have stalled. The French numbers appear to be moving back up again. And I guess it's worth noting that France doesn't have a full national lockdown in place at the moment, although there's talk that they may be forced to introduce a new one. And also in Italy, we're seeing cases rising there as well. And now with Super Mario Draghi installed as a new prime minister there, excuse me, there's considerable talk that there may well be some additional restrictions being introduced perhaps as early as this week due to what has been, in some parts of Italy, a significant increase in cases. So for the time being, I think the Eurozone really is kind of stuck. It's got a slow vaccine rollout. It's still got ultimately high cases of coronavirus, and indeed those cases appear to be going up. So I think the first stage for Europe is going to be a tightening of restrictions, or at very least a lengthening of restrictions, in the hope that they can get more of the vaccines out, to actually get the jabs into people.
Okay, so how would you describe the current level of net general restrictions in Europe? And it's substantial and or moderate or severe, and what pace right now is GDP growing?
Okay, well, in terms of the restriction side of things first, you've got to say they're pretty tight. I think, as I mentioned, Italy at the moment doesn't have a full lockdown, and nor does France, although both countries could do. The likes of Germany has had a lockdown now since middle of December time, if I remember rightly. That's been extended 2, if not 3 times, and currently isn't expected to be lifted until the end of March. And Germany at the moment is one of those countries where it has been pretty successful in bringing the rate down quite sharply since its peak, which was lower than many of the other countries anyway. But even in Germany, we've seen indications that the rate is actually starting to flatten out, if not even move up a little bit. Now, in terms of what it's doing for the real economy, well, I guess because the numbers tend to come in quite tardily as far as the Eurozone is concerned, it's hard to get an overall picture. But although we saw a relatively mild contraction in the real economy as far as the fourth quarter is concerned, we had an update there today which showed quarter-on-quarter growth just minus 0.7%.
Is that roughly what we're doing that right now, you think, in the first quarter?
I think it's probably less than that in the first quarter. And one reason I say that is that because we've had tighter restrictions introduced since the New Year holidays, retail sales, for example, for January, we have hard sales numbers. They were down almost 6% in the Eurozone month on month. And that's sort of the worst numbers we've seen for the Eurozone since, well, going back to the first virus wave back in April or May time of last year. So it started off with a very weak picture of demand. We've also had other indications in generally suggesting that perhaps the reduction in demand is starting to impact the supply side of the economy as well. Retail sales in Germany have been particularly weak. We've had some indicators of consumer confidence which are starting to drift lower, notwithstanding hopes about the vaccine rollout. So my guess would be at the moment we're talking about a steeper contraction in first quarter Eurozone GDP than we saw in the fourth quarter of last year. And of course, that would make for this much talked about second double dip recession.
And you also had German merchandise trade today. And that was interesting because it showed strength in exports and really significant continued weakness in imports. And is that and that import side is just reflecting weak German demand. Where is this export strength coming from? Is it coming from Asia? It might be coming from the U.S. significantly because import demand has been very strong here for consumer goods anyway, and also capital goods too. So, but that was an interesting how that switch, which basically is not an unsound economic outcome to have your country, cut back in imports at the same time expand your exports. So anything to say on that?
Yeah, I do. And I think you're right. Exports have been one of the key reasons why Germany, in contrast to a number of the bigger European countries, has actually managed, I should say, to keep its head above water in terms of the fourth quarter. We actually saw GDP expanding there, only 0.3% or so. But that compares with fairly sizable contractions out of the likes of Italy and out of the likes of Spain and out of a lot of the other Eurozone countries as well. Germany has certainly benefited, and you're right, I think, in where you put the regional strengths from the recovery in domestic demand we've seen out of the US, so your side, but also too out of China. Germany is, for manufacturing, capital goods manufacturing in particular, Germany is the key centre in Europe. And so as we've seen the Chinese economy in particular start to recover during the back end of last year and presumably as we go through the first half of this year as well, German exporters have really been making the most out of it. And so it's given a fairly significant boost as far as real GDP is concerned. In fact, exports have risen now for 8 months in a row. They're at the highest levels since February last year, so they're pretty well recovered all the losses we've seen since the pandemic first struck, and that's in contrast to most other European economies where exports are still well below. But while we're on Germany, just a point I'd like to just highlight from today's numbers, the German merchandise trade update. There's been obviously a lot of questions swinging it into my part of the world with the UK and what's happening to Brexit and has it really hit UK trade? Well, in addition to Germany, we've had a similar sort of picture coming out of France and Italy as well. But just to put some numbers on it, year-on-year growth of German exports, merchandise trade exports to the UK were down 29% in January. Imports going into Germany were off 56.2%. Now, the comparable figures for Germany for trade with the rest of the EU were declines of just 6% and 5.9% respectively. Now, trying to disentangle the effects of the coronavirus, which obviously is hitting everywhere around the world at the moment, and the UK leaving the European Union is pretty complicated, indeed nigh on impossible. But just the gaps between what we're seeing in terms of the trade with the UK and European countries and trade between European country members and the rest of the EU, it's so huge that it does kind of suggest that Brexit is having a negative impact on UK trade with the European Union. Obviously, We know we had a lot of stockpiling taking place in the UK at the back end of last year, and indeed on the continent as well, because they weren't too sure what was going to happen about the Brexit implications for trade flows. But I say, for what it's worth, the early indications are that Brexit has been a negative for the trade flows between the two regions. So it's going to be very interesting to see what comes out of the UK's own trade numbers. We'll be getting those on Friday.
And yes, so that UK hasn't updated their January figures yet.
No, we'll get them on Friday as part of, well,
but export. I'm looking at the last year's data, and exports are like down 20% consistently through the third quarter monthly, through the fourth quarter per month. That is already very severe, and it's very much the opposite of the German picture, which is strength in exports and weakness in imports. In the UK is low double-digit increases in imports. This again is fourth quarter data, and very sharp decreases in exports. Is this a topic in the business press there, or in the general press?
Only kind of. I mean, one of the issues with the UK trade numbers is that no one believes them anymore. The ONS, the Office for National Statistics over here, have been working on these figures for a long time now to try and improve their accuracy. They lost what they call their official national statistics status, where are we, 2 or 3 years ago now? Can't remember off the top of my head. So effectively, although the markets still look at them because it's the only real guide we have to what's going on in terms of the balance and payments and so forth, markets don't really take them too seriously. And of late, particularly during the course of the last couple of years or so, there's been some huge shipments in terms of what they call non-monetary gold imports and exports, which has really made a complete and utter nightmare of the numbers, which is why just between months you can get these huge changes in growth rates one month versus another month. So, having said that, it'll be interesting to have a look at when we get to these figures on Friday.
What about the business associations? Separate from the government data, do they have, and the lobbyists and things, are they making statements or producing any kind of data warning people that the trade situation doesn't look good?
Well, certainly, I think if you look at the exporting community, the biggest complaint at the moment is all the additional red tape and paperwork that exporters are having to fill in when they try to export a good or indeed a service into the European Union. As a result of Brexit, I mean, the amount of paperwork being done is, anyone's talking about up to tenfold or so compared to what it used to be. There's been a shortage of customs officials at the borders in order to check to make sure that the correct forms are being filled in, and they've been filled in correctly as well.
So, but are these one-time effects? I mean, once the firms figure it out, it'll,
Well, I mean, that's what the hope is. I mean, obviously, the government's view is we expected some teething problems. Therefore, it should be no great surprise that we've got some funny-looking numbers at the moment. But certainly, if you listen to what the British Haulage Association was saying, they were talking about the number of vehicles going through the Channel Tunnel and across into France. I think in January it was down the best part of 70%. So that's 70% compared to where we were last January. Now, it's difficult to work out exactly how much of this is Brexit, how much of it is due to COVID factors, but it does appear that the balance of payments numbers, UK and the EU, are going to be pretty messed up for at least several months to come.
But the big thing for the UK, in contrast to Europe, is the vaccinations. And you guys are opening. I read that you're going back to school now.
We are indeed. I'm give you anecdotal evidence on that. My daughter actually returned to school. It's not often she's happy to go back to college, but she was actually quite pleased having me stuck at home for the best part of the last 3 months or so. So yes, vaccine rollout has gone particularly well here. And that, I think, is being reflected in, well, certainly the level of the pound, which, as we've talked about before, has had an extremely good start to 2021. In fact, amongst the majors, it's been easily the best performing currency. And it's also been reflected in some of the revisions we're seeing to the economic forecasts. Notice, for example, the OECD came out today and just updated their numbers. So growth in the UK now has been revised up to 5.1% from 4.2%, whereas in the UK,
this is for 2021. This is
it's this year, yeah. The UK eurozone rather.
So what is it? 5%? You're in the 5% plus range.
5.1% now for the UK. That compares with 4.2% when the OECD last put their numbers together, and that really, as they admit themselves, is due to the rapid rollout we've had in the UK with regards to the vaccine. In the same sort of token, I mean, so I mentioned the Eurozone is a relatively sluggish 3.9%, but your side of the world, I'd be interested in what you think about this. The OECD now are talking 6.5% growth in 2021, and that compares with just 3.2% in their previous outlook. So, I mean, is this kind of typical states' view now, or are they outlook?
This federal stimulus is going through
that's what they said,
another round, and this is going to not only, it's going to boost the savings rate, and a lot of people are going to put the money into buying some things, but a lot of people are going to put it in the stock market for sure. This is a guaranteed funnel money into the stock market. A lot of this money is going to be gambled, and so we're going to see a lot of froth, which maybe is a good thing, as long as you don't get runaway issues like a runaway inflation. The concern right now is that we're getting this inflationary spike, but still, it looks to be just taking rates up to the moderate kind of subdued levels they were before the pandemic hit, as opposed to the depressed levels during the pandemic. But the risk is that you're going to get some dislocation, bubbles in asset prices, housing, bubbles in the stock market, bubbles in inflation, bubbles in long-term rates. And so it's this, the pace of this change that is what's at risk here with all this stimulus, and it's driving up, like you were saying, a GDP forecast for the states, which was 6% now for, and
6.5% are talking for you in 2021.
Okay, well, I mean, that would be would it create jobs? I guess ultimately is what the question is for policymakers here, and I guess that's a segue for last week's, if you don't mind, Jeremy, for last week's employment report in the U.S., which was very strong. It's what you want. 379,000 headline in payroll growth in the month. That's the kind of pace that you need. That's roughly twice the average, or even a little bit more than it would be during normal time. So that's the kind of thing you want month in and month out. This is just a 1 month event, however, and it followed weakness in the prior 3 months, and it kind of takes it up to where the rates were in the initial recovery period, which is a positive. And it was centered right where in the leisure and hospitality area, which is in the U.S., even though cases have come down significantly over the last 6 weeks or so. And in any case, reopenings are increasing. As we know that Texas reopened completely last week, and so there is this, and this is going to be improving this that sector that has been hit the very, very hardest, retail too, by the pandemic, and so that part of the recovery and these folks getting jobs will be helping to stimulate the economy through the year. So I'm not surprised that we're going to get it, a rebound. But for policymakers, they have to watch for these bubbles and going too far and pulling things back when they need to. And I guess this risk is being played out initially for us in what's been happening with long-term interest rates.
I've got to ask you, I mean, if you were to get the March employment report as strong as we saw in the February one, do you think then the Fed would feel obliged to start just changing its tune a little bit? Or is it going to take a whole swathe of these numbers before they actually start saying, well, okay, perhaps we're doing rather better than we'd originally thought?
I don't know. They haven't been through this. This is, we don't really have any precedent with this, generation of policymakers to see what tack they would take. Would they take, a slam down tack like, Paul Volcker in the 80s? I don't think so. They have been resisting even giving any kind of initial signal that they are even thinking about withdrawing stimulus. So they have to give that signal first. And the problem with giving that signal, however subtle, is like, especially when these markets are so frothy, that there will be a huge swing an oversized swing in what would be a pulling out of risk, which which would be a significant negative. So I don't, I mean, this moment has to be approaching, and the more stimulus that's being poured in, the sooner that, and the more restrictions are declining and COVID cases are declining, the sooner that's being brought forward. But it hasn't been. There's been no action on it yet. Oh, I have a question about the ECB and their PEP. Is it possible that they could? Do they buy on the sly ever? I mean, could they do this without informing the market?
Not really. I mean,
Changes?
they do produce weekly bond data, which is something that markets do look at quite closely now. They tend to be updated, not completely on a Thursday, and then we normally get the final data coming through the beginning of the following week.
Are they ever shocking and surprising, this weekly data, or is it already?
Well, they can be a bit volatile, and as ECB itself has been making out, there's been a number of redemptions taking place of late, which has tended to make interpretation of these numbers a little bit harder than usual. But I think, to the extent they actually provide the data, it's going to be difficult for them to actually, to do it, as you say, in an underhand way. And indeed, I'm not convinced they'd want to do it in an underhand way to the extent they probably want to be seen, to be doing something, to really, emphasize the fact, look, they've intimated they don't think, yields should be this high, and they're actually prepared to come out and introduce some concrete action to do, exactly that. But Thursday, certainly ECB should be interesting. Potentially not quite so interesting, but it could still certainly grab markets' attention is the other major central bank meeting this week, and that's the Bank of Canada will be getting tomorrow. So consensus is very strongly that we won't see any change in the benchmark overnight interest rate. That currently stands at 0.25%, which the bank currently views as its so-called effective lower bound, and we won't see any change in net asset purchase under the bank's quantitative easing program, which currently stand at a minimum of 4 billion Canadian dollars a week. However, Canadian numbers that we've talked about on recent podcasts have certainly surprised on the upside of late. The resource production side is doing very well. The housing market in particular has been especially strong. Fourth quarter GDP out of Canada at an annualized rate is 9.6%. That was double what the Bank of Canada was expecting. And although the bank's looking for a 2.5% contraction in this quarter for GDP, at the moment the growth numbers, although it's early days yet, growth is tracking something probably closer to plus 3%. That means that Friday's employment report out of Canada is going to be well worthwhile watching. But the bottom line, it does seem that although the bank has typically tended to be, if anything, slightly dovish in its recent statements and very much plugging the line that we're not going to see any move on interest rates until inflation's sustainably up to 2%, and that's not going to be until we're well into 2023. It could well be the case that in light of recent numbers, the tone of what they have to say on Wednesday won't be, well, let's say, at least quite so dovish. There has been speculation, as we've spoken about before, that the Bank of Canada could be amongst the first of the big central banks to start tapering quantitative easing this year. And although April probably seems a bit of an outlier as far as expectations for that go, it may be they'll start just changing a little bit the tone of their statement to get markets thinking about the possibility of them doing it in April or May. In fact, April is going to be the key one because that's when we'll get the updated quarterly economic forecasts. And that, of course, will give them the potentially the fundamental justification they might want to actually come out and do something. So
well, let's talk about the ECDI. That's Canada's Consensus Divergence Index. Now, for Canada, that I'm just looking at, it ended last week at plus 22, and that's a pretty solid score, indicating that Canadian data in general on net has been visibly exceeding expectations. Now, if we do these indexes for the individual countries where consensus forecasts are abundant, available, and what we're seeing, and tell me if I'm wrong, Jeremy, is almost a complete, outside of France, a complete strong indications or strong strength across the major economies in Europe and North America that data have been outperforming expectations. Now, these expectations may have already built in improvement and a degree of acceleration, perhaps, and the data have been exceeding that. Now, is this, Jeremy, a factor in the increase in long-term rates underway? That economic data have been consistently beating forecasts, and that creates inflationary worries and has an effect on the bond market.
It's certainly consistent with it. And personally speaking, I'd most definitely say yes. I mean, we know, just taking my part of the world and looking at Europe, people will say, well, hang about, look at Europe. Everyone's talking about a second double dip recession. First quarter growth is going to be negative. Well, that's hardly inflationary. Well, that may be true. Nonetheless, as you said, it's a case of what's really discounted in the market. And if markets are already anticipating a very weak first quarter, but the economic numbers coming in suggest it's not going to be as weak as they originally anticipated, then it's perfectly sensible to assume, well, on the back of that, inflation could be slightly higher than we previously thought. And therefore, it makes sense to assume that, longer term bond yields, unless the ECB is going to try to do something about it, longer term bond yields should be moving up. So yes, and I think it's important, as you say, when you look across the swathe of countries for which we produce these indexes, outside of France, which is partly struggling, I think, because it hasn't got the lockdown, and that's starting to be reflected in the coronavirus cases, and it's undermining a lot of things at the moment. Outside of France, really, we're generally talking about, over the last several weeks now, economic numbers have been coming in on the strong side of what the market's been anticipating. And so on the back of that, you can say, well, why shouldn't longer term yields be higher? Yeah. Okay. What else we got? Anything from your side you want to chip in with?
It's a slow week, so I'm, just laying low.
Happy to end it there. Yeah, I'm with you on that one. Okay, then. I'm having said which, we've probably been prattling on for quite long enough anyway. Okay, let's wrap it up there then. On behalf of Mark and myself, thanks as always for listening. The podcast, as usual, will be back next week, but in the interim, everything you need to know about key market moving data and events can, of course, be found in Econoday's global economic calendar. We'll see you next time. Bye for now.